Okay, so now in the second video, we're going to show you a whole bunch of different ways to calculate break even. It all derives from the same equation, right? You're always trying to figure out what it takes to cover your fixed costs. But depending on the information that you have, there are a number of different formulas that you can use. And so we are going to use a few different formulas here. We are going to use an equation that uses operating income, and we are going to use an equation that uses contribution margin. And then what we're going to do, just to make sure we got it right, is we're going to prepare a contribution margin income statement based on the break-even point. And basically what that's going to tell you is whether at those units, whether your profit is zero. Okay, so we have a couple of different ways that we can calculate the break-even point in units. Okay, so the first is starting at the very basics, which is that we know that operating income or profit is equal to revenues minus costs, right? So we know that, and we can also say that our revenues is going to be price times units, so that's revenues. And our costs are going to be variable cost times unit, so that's total variable cost minus total fixed cost, right? And so here we have our numbers, right? So we want an operating income of 0 when we're breaking even. And we've got our price times the number of units minus our variable cost times the number of units minus the fixed costs. And so we do a little, rearranging in algebra, right? So how about we take and bring, let's see, if it was me, I'd bring this 45 over to here, right? So I'd do the algebra by saying 45,000 is equal to 400 minus 325 times units. Right, and so therefore you can just simplify it to have your units equal to your fixed cost divided by the contribution margin per unit. Right, so that is basically starting from the operating income and getting to essentially our sort of simplified version of this equation, which is this one here, right? Our break-even number is going to be total fixed cost over unit contribution margin, right? If you were taking an in-class exam, you want to memorize this formula, but most importantly, you want to memorize this one because this gets you to everywhere you need to be. Same equation, essentially, just a different way of stating it, gives you the same number, and then what we want to do now is get to a contribution margin based on 600 mowers. And so here's a simple little contribution margin income statement. Here's our income, $400 times $600 mowers, 240,000. Variable expenses of 325 times 600 mowers gives us 195. Total contribution margin gives us $45,000, which is 240 minus 195. That is equal to our fixed expense, so that gives us an operating income of 0. Obviously, this is really easy to do in Excel, and I will show you that in a later video. Okay, you can also use cost volume profit analysis to look at what your sales revenues are that you need to achieve. Obviously, if you calculate your units sold and then you multiply it times price, you'll get to the sales revenue that you need, or the sales dollars that you need in order to break even. In our example here, our sales revenue for break even, given our cost structure, is 240,000. Now the next little bit of information that we're going to need is a simple ratio called our variable cost ratio. right? So these ratios are generally expressed in terms of the relationship to the price, right? So the variable cost ratio is variable cost per unit divided by the price. So if we have variable costs of $6, this is just an example, right? We have variable cost of $6 and a price of $10. That means our variable cost ratio is 60%. 60% of the price of our product is made up of variable costs. And therefore, for that same example, right, we had a cost per unit of $6, variable cost per unit of $6. That means that our contribution margin per unit is $4 if our price is 10, right? So we have a 40% contribution margin, right? So our variable cost ratio plus our contribution margin ratio are going to equal 100%, right? Because one of the other things we can think about is price is going to equal variable cost plus contribution margin, right? Our contribution margin is everything that's left over after our variable costs. Therefore, right, variable cost ratio plus contribution ratio have to be 100%. That makes sense, right? Okay, so here we have a couple of very simple calculations from our same example of that lawnmower company where we're selling lawnmowers at $400 a piece, and they cost us $325 a piece in terms of the variable cost, and we are going to be asked to calculate the variable cost ratio, contribution margin ratio, and then we are going to make a percentage-based contribution margin income statement. So here we go. Our variable cost ratio is the variable cost per unit, which is 325 divided by the price of 400, or so that gives us 81%. And then here we have the contribution margin per unit is $75 per unit. And our contribution margin here is calculated as $75 over 400. And my friends, this is wrong. It is not 81.25%, right? 75 over 400 is going to be 100 minus 81.25, or 18.25%, right? So now here we have our same contribution margin income statement with our sales minus the variable expenses, gives us our contribution margin, and gives us an operating income of $30,000. These ratios, right, the variable expense ratio and the contribution margin ratio show up as these percentage of sales here. And it's quite often useful to indicate percentages of sales on an income statement for a number of good reasons, which we will probably talk about in a financial management class. Now, the reason that we calculated that ratio, or those ratios, is not just for a mathematical exercise. It is useful for active management, right? If you are a general manager, and if you know your contribution margin ratio, you can immediately see how close you are to breaking even if you're just using your total revenue data, right? So usually there are daily sales reports, monthly sales reports. Sales are known and distributed immediately, right? But financial statements are prepared periodically. So if you know what the contribution margin ratio is, and you know what your fixed expenses are, and your fixed expenses should be known as well, right? You know what your rent is, you know what your salaries are. So the fixed expenses are known, the contribution margin ratio is known, then you are going to know what your break-even sales dollars are. And so you're going to know all along as the year goes on how close you are in terms of revenues to the point where you're going to break even. This is a critical piece of information that managers are always watching. Okay, so we're going to do it again. We are going to use that same example. We've got the $400 mower, which variable expenses are $325, so our contribution margin ratio, of course, is 75 out of 400. As before, we're going to calculate what the target sales revenue is, or the break-even sales revenue, right? So not the number of units, which, as you recall, I believe was 600 units. We want to know what the break-even revenue is to cover that fixed expense of $45,000. So here again is our contribution margin ratio calculation, which gets us to that 18.75 figure that we saw before. So then we calculate our break-even sales dollars as our total fixed cost, $45,000, over our contribution margin ratio of 18.75%. By the way, you don't want to round this. You want to always have all 4 decimal points, because otherwise you'll have a rounding error. This gives us our our break-even sales of $240,000. And so then our last little task we need to do here is to prepare, once again, a contribution margin income statement based on that sales level, which, as expected, gives us an operating income of 0. Here's our sales minus our total variable expenses. We derive variable expenses by multiplying the variable cost ratio by the sales. That gives us a $45,000 contribution margin, which is netted out by the fixed expense to give us a 0 profit. So that's how you do all these various different calculations for break even.